Apple is undoubtedly one of the best companies of our generation. Over the last 25 years, the stock has absolutely destroyed the market. But do you know where Apple's growth is coming from today? It may not be the products that you think, and in particular, it's not the iPhone. So that's what I'm going to dig in today. If you are looking into Apple stock, you need to understand where the company's growth is coming from and what that means for the future. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool, check out fool.com/ASYM for their top 10 stocks to buy right now. Now, the iPhone is undoubtedly one of the best products ever to be introduced. Over the past year, over $200 billion of revenue from that single product alone. Incredibly high margins. It drives an incredible ecosystem. But let's get into exactly how much of a growth product this has been, because I think this is what's surprising when you start digging into the numbers. This is a chart showing the iPhone revenue, Mac revenue, and iPad revenue since 2015. And that was really a critical year because that was when growth in a big way stopped growing for particularly the iPhone. So you can see that since 2015, so an 8-year span, the compound annual growth rate for iPhone revenue is just 3.3%. Mac revenue, we see a very similar story. Compound annual growth rate of just 1.8%. An iPad compound annual growth rate of just 2.5%. So given the fact that iPhones are everywhere, the Mac is taking market share from the PC, why is it that these products are not growing as much as you might think, especially given the fact that Apple's stock has done very well in this time period? And the reason is these products are just simply lasting longer. The refresh cycle on the iPhone before 2015, so about an 8-year span, was regularly every 2 years. If you went 2 years between iPhones, you had a noticeable difference when you upgraded to a new device. Now, I think it's pretty hard to notice the upgrades in devices even 2 or 3 years out. So people are elongating that refresh cycle. There are more people who are using iPhones, but they're not buying them as frequently. The price has also gone up. So that's pushed that refresh cycle out even further. Despite the fact that Apple has more devices in the field, prices have gone up. The volumes have actually gone down because people are holding on to their phones longer. That's why you see that growth rate really slow. Macs, very different story. People just simply aren't refreshing their PCs as much as they used to. And then I think the iPad, we're seeing something very different. That's just a product that has never really taken off in the way that Apple would have hoped. In the past year, $28.3 billion in revenue. That's a little over a tenth of what they generate from the iPhone. So the iPad, maybe not necessarily the best success product for Apple, but there have been huge successes, and that's what I want to get to next. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Apple's growth over the last 5 to 10 years has really been driven by accessories and services. Accessories are things like AirPods, something that you see a lot of people using, and if you have an iPhone, it's very likely that you have AirPods as well. And that refresh cycle on AirPods seems like it's much shorter than it is for iPhones. So great revenue driver for Apple. Services is all of the revenue that Apple generates from credit card processing, from the App Store, and of course that giant check that it gets from Google for Google being the default search engine on Safari. So let's look at the numbers here because this is what's really impressive. You can see that wearables revenue in 2015 was just $10 billion. That has gone up 4x to $39.8 billion in the past year. At the same time, services revenue, $19.9 billion, that has gone up more than 4x to $85.2 billion. The compound annual growth rate on those two, 18.7% for wearables, home, and accessories revenue, and services revenue, the compound annual growth rate, 19.9%. So that is where we're seeing the growth for Apple, is accessories like AirPods, like HomePods, all of those other products outside of the core of the iPhone, the Mac, and the iPad. And those hardware products are doing extremely well, but it's really services driven by and really helped by that Google revenue, that search revenue, that is driving a lot of the growth. Now, I think this is something where you need to think about the risks as well. Like I said, $85.2 billion in revenue for those services in the past year. The reported number that Google is paying Apple to be the default search engine is around the neighborhood of $20 billion. And that is partly a revenue share deal. So if that deal is deemed to be illegal, the Department of Justice is suing to block that kind of a deal, it's very possible that that revenue disappears or at least declines for Apple. And that's revenue that's basically 100% margin. That just flows straight to the bottom line. So definitely something to think about with Apple. But what I think is fascinating about Apple from an investment perspective is the stock has done extremely well despite the fact that the core products are not growing in the way that you might think. What is growing is these ancillary products, the accessories, the software. Those can be very high margins, very high profitability. Apple has also returned a lot of money to shareholders through buybacks and dividends, but the growth may not be exactly where you think it's coming from. The next question is Apple stock a buy as a result? If the growth is coming from these non-core products like the iPhone and the Mac, and it's growing basically by squeezing more and more revenue out of their customers, what kind of multiple should a stock like that trade for? And I want to go through some of the numbers because I think this is where I get really hesitant about both buying shares of Apple stock and then think about potentially selling the shares that I do own. Price to earnings multiple right now is 28. The forward price to earnings multiple, so that's based on analyst estimates for the next year, that price to earnings multiple is 26.5. So that's a very high multiple for a company that's very mature in its growth phase. And the growth rate may not be what you think. The 10-year compound annual growth rate for Apple overall as a company, 8.4%. So a lot of the stock returns that we've seen over the last 10 years for Apple are not because the company is knocking it out of the park from a execution perspective and from a growth perspective. It's really because the market is giving more credit to the stock. We're seeing multiple expansion. In the early to mid 2010s, you could buy Apple stock for under 10 times earnings when you pulled out cash. Well, today that's absolutely not the case. That stock multiple is more like 30 times earnings, and the balance sheet isn't quite what it used to be either. There's not as much cash just sitting there on the balance sheet, partly because they're deploying it to do things like buy back stock and pay dividends to investors. So I think the question at the end of the day is, have the tailwinds for Apple started to subside? And I tend to think that's the case. And the fact that the core products that we know Apple for, the iPhone, the Mac, the iPad, are not growing, not even at a double-digit rate. They're growing at a very, very low single-digit rate. That is a huge red flag for me. Now, it's great that some of these accessories and services are growing, but I think there's only so much you can squeeze from that. If people are elongating their purchase cycles for the iPhone, then it seems natural that you would start elongating purchase cycles for things like AirPods. Services are something that there may be a limit to how much Apple can push that. How much can they squeeze Google? How much can they squeeze their developers to generate more revenue for the App Store? Yes, that has been a phenomenal growth driver for Apple, but services has never been the core of what Apple is as a business. So the fact that they're leaning on that as much as they are, and I think potentially in a way that is damaging to some of the partners that they work with and they rely on, like developers, I think we're going to start seeing more options to move elsewhere. If that revenue growth slows, if accessories revenue growth slows because everybody already has AirPods, then we're stuck paying a very high multiple for a company that isn't a growth company any longer. So what do you think about Apple's growth segments and where they're actually seeing success in the market? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.